Golden Rule Radio. We welcome you back, and our sincere condolences to anyone affected either health-wise or financially, if not both, with everything going on in the country right now. This is history we are living in, and it's saddening to hear about job losses, illness, and obviously the extreme being even death. It certainly puts everything into perspective for us, and yet we're going to continue to update you on this little piece of the big picture, if you will. But that being said, without further ado, Miles, why don't you take off into the technical aspects of gold, and a lot to talk about today.
Thank you, Tori. So as we're ending first quarter of 2020, at least market and metals-wise, we did, after having a nice rebound, the big crash a couple weeks ago in pretty much everything, gold, silver, the physical metals themselves coming alongside, nowhere near as bad as the mining companies did, but coming down as well, and a bit of a rebound back up. But gold did sell off here right at the end of the month, posting some down numbers here for the last, or at least trying to get some lower prices in before the end of the first quarter of 2020. So gold's currently sitting a little bit under 1,600. Now, again, I'm going to go back to the price we talked about last week, us holding that 50% line around 1485 and coming back up. I think that is a solid line in the sand for the time being. Obviously, we'd want to see higher prices in this bull market, this phase of the bull market, but it wouldn't surprise me to see things turn sideways. We have a lot of economic instability, obviously taking place right now, and we have our normal seasonal stuff coming up here over the next few months. We are coming into spring, coming into summer. Now, this is going to be a very different year than I think pretty much any of us have experienced.
No, that's a good point, honestly, because seasonal trends kind of are out the window right now because we're in such uncharted waters. And so in a month where gold rallies, and I was telling clients this 2 days ago, you have to expect the price to come down in that final day of a month, right? Not only the final day, but the final day of a quarter. All right. And so it was no surprise to see gold come off. And, as Bill King put it, some mysterious entity wants gold lower for month end. And that happens to us often. Maybe it's portfolio positions, maybe it's, gamesmanship where you're trying to make a portfolio look even better, lock in profits for that month, for that quarter. But this is precisely what occurred in June, July, August, September, October, and now February and March. And so get used to that month-end gamesmanship of driving that price down. But as you alluded to, it's futures market, it's spot price, it's not the physical market, and we'll get into that later.
Yeah, and despite all of this, gold is up for the year. So, and I think that's important to remember too, despite the volatility over the last 3-4 weeks, start to finish, January 1st to today, gold is actually continuing to climb. So that's why sometimes you just have to let panic be panic, but eventually the trends overpower the short-term black swan events. Speaking of the trends continuing, moving over to silver, silver obviously has not seen those breakouts that gold obviously has over the last couple of years. So silver fell off the cliff along with everything else here in March. Bounced, had about a 50% move up, which we mentioned last week. And just like gold did, Tori was talking about the metals all pushing down a little bit the last couple days just to scrape a little bit of that profit off the top. So again, when this all continues to resume normally, looking at those ratios, I think we topped 125 to 1. So by my record, that's about the highest gold to silver ratio you've ever seen.
That's a really, really good point, Miles. And it's actually important to realize that, yeah, it was 125 to 1. It's come down to 113 to 1 today on Wednesday when we're recording. That doesn't mean that you're going to realize it based on the supply and demand issues that are in the market. So if you, for example, are swapping from gold to silver, American Eagles, all right, the ratio comes all the way down to like 80 to 1. If you're going into 100-ounce bars, it's like around 90 to 1. So you've got to take into account what the real cost of the product is that you're acquiring. If you're able to get into these big 1,000-ounce bars, now you're going to realize a greater than 100 to 1 gold to silver ratio and really setting up your portfolio for that strategy most ideally.
So taking a look at the other white metals, platinum, we mentioned this last week, hitting those 2002 prices. So in about 2 weeks' time, losing not just days, weeks, but decades worth of growth. But platinum obviously has bounced back up. You know, when you take a $300 drop, you're going to take a $150, $200 rise. So it's reacting the way you'd expect it to in this type of crisis. And everything this past couple of days really has sort of settled down in the metals. Now that's going to be a little different when we look at the equities here, but at least the metals had their initial system shock and are finding a little bit of footing.
Yeah, remember too, platinum all the way back to 2002, it might have come down to these levels, but what happened by 2008? It was over 2,200 an ounce. So you can still see market variabilities where it will allow something to thrive, just like what you're seeing palladium still do, if you can talk about palladium a little bit.
Sure. Palladium came down about 52% and hit some pricing prior to the big run-up since August. You know, we were at like 1380 last August, and next thing we know, we're at like 2,700. So over the course of six months there, palladium explodes. It's not unlikely that in this type of crisis, it crashes, loses all of those gains. But it has bounced. We are back up over about 2,300. And again, the harder you fall, the harder you're going to bounce, and that's exactly what palladium has done.
Coming back around to the physical real fast, please understand that the futures market spot price disconnects from the physical market price. Gold and silver are setting their own prices in the physical market. Some of that is just because of the real demand. I can tell you that people are acquiring and adding to positions with the physical precious metals. The futures market can do whatever it wants, just like it did in 2008 and 9, and yet you're running out of supply on the physical side, right? So you want to touch briefly on the miners, Miles, just so we can address the listener questions?
Yeah, I think it's important for any gold buyer to understand that from time to time, product availability or good old-fashioned supply and demand ends up overpowering pretty much every other aspect of the market. So when you've got obviously in a situation where you've got the equities market as a whole taking a wash, anything associated with or traded on that equities market is going to take a bath with it. So plus you have the secondary effect of the fact that a bunch of companies are literally just shutting down operations right now, including some of these mining companies, logging companies, a number of commodity dependent firms. So you have situations where, say, gold takes a 20% drop and bounces most of the way back up. You have mining companies that are taking 40+% drops and are not rebounding right now. You know, BHP Group, Rio Tinto, Vale, Glencore, Newmont. Newmont actually is doing okay right now, but a number of other companies just taking a wash. And that's because they rely not just on the sale of their actual goods and services, because that's not how the market works anymore. The market works based on how Wall Street's doing. So it doesn't really matter if you're selling stuff. You know, I always talk about how I like to start with the transports, because if you're not shipping goods, you're not actually selling goods. So if the transports are falling, if commodity companies are falling in price, if the stock market as a whole is falling, but the commodities themselves are rising, the price of an actual ounce of gold is going up, while the price of a mined or futures market or ETF or mining company is going down, that's when you see these massive disconnects. And for anybody who's had the cash available, who's seen this writing on the wall, now, again, we didn't know what the catalyst was going to be, right? Nobody knew 2 months ago that the COVID-19 virus was going to kick off this huge economic collapse. But what it has done is it's shown that there are cracks in the dam. And we've been talking about that. A lot of people have been talking about that for a long time, that all this market really needs is just one solid catalyst to show the weakness.
Yeah, the opposite is true, actually, in some other sectors. I mean, look at oil right now. Supply is way up and demand is way down. When you have an economic slowdown, you don't have people flying, you don't have people driving, so that the demand drops precipitously on top of a lower price. So if that was going on in the precious metals markets, you would actually see the opposite. We would have a glut of supply. And so completely different sector. In fact, my son's company, he's a petroleum engineer, lost his job yesterday because a company of 60 employees shut its doors down in the Permian Basin. The exact opposite is happening in many market sectors. But for the most part, that's going to be the story for this country going forward, not just in the oil and gas sector, but in many sectors, restaurants and everything else. So keep your eyes and ears open for that. And really what I'm interested in seeing play out is what happens with our currency. We haven't talked about the U.S. dollar yet today. if you don't mind throwing up a chart on that just to kind of see where we are. But here, President Trump came out and said, look, now that we have zero interest rates, now is the time to do our $2 trillion infrastructure spending bill. Now, we're already about $6 trillion into this. When you take into account what the Federal Reserve has done from an intervention standpoint, the $2.2 trillion CARES bill that Congress passed and the president signed, now you're talking about adding another $2 trillion on an infrastructure spending bill, and you have Part 4 and eventually 5 in terms of an economic recovery stimulus that will be passed by Congress. I mean, Miles, we have to assume at this point we were going to have a $1 trillion budget deficit before this all started playing out. That's per the Congressional Budget Office. Now you're going to have at least a $3.5 trillion budget deficit, and that's going to grow. If they actually start to pass these things and spend like this, anyway, that's what's going to weaken the dollar, if you don't mind throwing that chart up.
So with an expected $1 trillion automatic deficit plus adding, let's say, another 4 on top of it, we're looking at a U.S. economy annually of about $20 trillion. So we're inflating an extra 25% of the size of our entire economy this year, which will have very long-term repercussions. And that's just what we've talked about over the last couple weeks. I mean, if the Elizabeth Warrens and the Nancy Pelosi's get their way, we're going to inflate ad infinitum. And at that point, it just doesn't matter. So this is where you get into the discussion. And when you look at this dollar chart, you're wondering, well, why hasn't it fallen off a cliff? And the reason being is because of demand for U.S. dollars. The rush to liquidity is urgent worldwide. And the U.S. dollar is still the most liquid asset out there until it isn't.
Right. Then it becomes a psychological event. But just a reminder that since the Fed was born in 1913, the dollar has lost 96.13% of its value. And that's a report that just came out this week by the Minneapolis Fed itself. So that's not some fabricated number. That comes straight from our central bank. 96% loss of purchasing power. And that's why I say, there's taxes and death are two guarantees in our life. Well, so is inflation. That's a loss of purchasing power. And I compare it oftentimes to a monopoly board. The more money that there is in the game, the higher the property values climb. That's inflation. So they pump the system with money, expect prices to climb, and expect gold to climb over time, another guarantee, because that is the economic intervention of choice.
Well, and keep in mind, it takes time for that type of economic stimulus to make its way through the entire market.
No, that's right. And it takes time to see the fallout from an economic slowdown, too. Some of these numbers can take months or a quarter. I mean, sometimes we'll go 2 quarters ahead only to revise numbers from 2 previous quarters. It's going to be far uglier. So there are people saying, oh, this whole response to the COVID-19 pandemic is overkill, or it's a hoax, or it's panic-driven. Well, what is not a hoax is the economic fallout from this. And when you see that we're all the way down to where we were in 2009 and already in terms of the economic contraction with the initial numbers coming out, and we haven't even peaked in terms of the spread of the virus. So as the president said, we're in for a really ugly 2 weeks. Well, we're in for a really ugly 2 quarters as well, as it takes things, even if they halted at the end of April and things started to reverse. The economic fallout from this is going to be significant. And again, as I said last week, I think we're probably going to go into a global depression.
And that's why you do things like hedge against your risk, right? You own precious metals. We're a 48-year-old company. We still have supply available in the precious metals market, at least for the foreseeable future. Obviously, that depends on how long this goes. But you do want to do the types of things that just bring a little bit of protection to yourself, your financial situation, your family, and the community around you.
Yeah, we've obviously helped our clients weather storms like these before over the course of 48 years. So give us a call while we do still have plenty of supply. I mean, part of the beauty of a 48-year-old history is the network that you build and the contacts that you have in the industry. And we can still get access to plenty of metals. So thank you. That's it for this week's show. We appreciate you joining us. Everyone stay healthy out there. Make sure to follow us on Twitter at ICA Gold. Subscribe to this podcast by clicking the subscribe button below this video. You can also like us on Facebook at McIlvaney Financial, or go to our website, McIlvaney.com.
And if you'd like to discuss your personal portfolio with us or one of our advisors at ICA, you can give us a call at 1-800-525-9556. Thanks for listening.
Have a great week.